Hello traders and welcome back to the Forex Geek. In today's video we're going to be exploring a crucial tool that can help you refine your trading strategies. So we'll be looking at the rolling moving average. So whether you're looking to identify trends, pinpoint entry and exit points, or simply improve your market analysis, understanding how to use this indicator effectively is essential. So by the end of this video, you will have a clear grasp of how the rolling moving average works and how it differs from other moving averages, and most importantly, how you can apply it to your forex trading strategy for better results. So stay tuned to learn how this powerful tool can give you an edge in the market. So without wasting much of your time, let's get started. So first, we'll look at what a rolling moving average is. A rolling moving average is a technical indicator that calculates the average price of an asset over a specific period. It continuously updates as new price data becomes available. So unlike simple moving averages, which gives equal weight to all data points, rolling moving averages places more emphasis on recent price action. Okay. And this indicator smooths out price fluctuations, helping traders identify trends and potential reversal points. The rolling moving average adapts more quickly to price changes, making it particularly useful in fast moving forex markets. So, the rolling moving average can be applied to various time frames, from short-term intraday charts to long-term weekly or monthly charts. We are on the 4-hour charts currently. Let me just check the daily chart, and you can see it on the daily chart. So the choice of period depends on your trading style and the specific currency pair you are analyzing. So one key advantage of the rolling moving average is its ability to reduce lag, which is a common issue with traditional moving averages. And this reduced lag can be crucial in forex trading, where even small delays in identifying trend changes can significantly impact profitability. So notice how the rolling moving average in this chart provides early signals of trend reversals compared to other moving averages. This early detection can give you a valuable edge in your trading decisions. You can see where we had the break, where we had the shift from bearish to bullish. You can see market giving us several touches to the rolling moving average, using it as a support as it pushed price up. This is actually the 9 period moving average, so I'm just gonna edit it to 20 period moving average so we can see. Okay, you can see price breaking. You can see the clear break here, and I have the pullback back into support and the continuation to the upside, and we have price using the rolling moving average as support in its push to the upside. So you can see this one had price go under the rolling moving average, signaling we are in a bearish trend, and we should be looking for price using the rolling moving average as significant resistance levels. You can see, so it reduces lag compared to traditional simple moving average or exponential moving average. So let's talk about the mathematics behind rolling moving average. So the mathematics behind the rolling moving average is what sets it apart from other moving averages. Let's break down the formula and understand why it's more responsive to recent price changes. So the RMA is calculated using the following formula. I'm just gonna type it on the screen, and let me type it. So the RMA, or the rolling moving average, is equal to the previous RMA times the number of periods minus 1, close the bracket, plus the current price, all divided by the number of periods. So this is the formula. I'm just gonna add something to it. RME. Okay. I change it to black. And this is the calculation of the rolling moving average, where n is the number of periods and the previous RMA equals the RMA value from the previous period, and current price equals the most recent price data point. So this recursive formula gives more weight to recent prices while still considering historical data, and the key difference lies in how it updates with each new price point. So the RMA's calculation results in an exponential smoothing effect similar to the exponential moving average EMA. However, the RMA uses a different weighting factor which can lead to slightly different results. So let me just add the EMA to the charts so that we can compare the EMA and the rolling moving average. So we have the EMA on the charts. Let me just edit it to 20 period EMA. And also I have to edit the color. The EMA is red in color while the rolling moving average is blue in color, and the rolling moving average is the thicker line as you can see, but the EMA is slightly faint, so that it can help us differentiate between the two moving averages. And for the weighting factors, let's compare the weighting factors. For the RMA, the weighting factor is 1 divided by n. RMA weighting factor is equal to RMA weighting factor is equal to 1 divided by n, and if you are looking at the EMA, the weighting factor is EMA weighting factor is equal to 2 divided by n, which is the number of periods, plus 1, and close the bracket. Now this is the weighting factor, and you can notice how the RMA, which is the blue line, and the EMA, which is the red line, tracks closely but with subtle differences, as you can see. So these nuances can be crucial when fine-tuning your trading strategy. And the mathematical properties of the RMA makes it particularly useful for Forex traders. Its ability to adapt quickly to price changes while still maintaining a smooth curve helps in identifying trends and potential reversal points with greater accuracy. So understanding the math behind the RMA allows you to better interpret its signals and adjust the indicator to suit your specific trading needs. So enough of the mathematics and formula. You could just take a screenshot of this, or you could come back to watch the video. Let me just delete it. Okay. Now I'm gonna delete the EMA also. Now let's talk about how you can use the rolling moving average to trade. Enough of the mathematics. Let's talk about how you can use it in your strategy. Let's explore some effective approaches to incorporate this powerful tool into your trading arsenal. So one of the primary uses of the RMA is to identify and confirm trends. So a simple yet effective strategy involves using two RMAs of different periods So I'm just gonna add a second rolling moving average. Rolling moving average. I'm just gonna add a second one, and we have two. One of them is gonna be red in color, which is the 50-day moving average is going to be red in color, and the 20-day moving average is going to be blue in color. So you plot a short-term rolling moving average, example a 20 period, which is the blue color moving average, and a long-term rolling moving average, which is the 50 period moving average. You plot it on your chart, and when the short-term rolling moving average crosses above the long-term rolling moving average, it signals a potential uptrend. Conversely, when the short-term RMA crosses below the long-term RMA, it indicates a possible downtrend. So you can see this. We had this wonderful cross here, showing that this bullish trend that we had quite a very good bullish run here, and then we had this cross. Remember, the rolling moving average is weighted and it shows price action as it changes, so it does not lag. And you can see the cross right here. We had the cross here signaling that we are now bearish. Had several touches to the rolling moving average. Had one here, had one here, also had this fake out and a continuation. So you should look for trades using your normal support and resistance, but as we had this cross, it signifies that we are now bearish, and you should be looking to enter bearish trades. You could use your candlestick patterns, or you could use your major key levels like your resistance levels. In this case, we are bearish, so we'll be looking at resistance levels. You see price coming back to tap into this resistance level after this cross. You can see this rejection off of that resistance zone, and we have further taps into this level here, and you can see series of candlestick patterns, bearish candlestick patterns, giving us confirmations that we should be looking to sell. You can see this shooting star candlestick pattern. You can see the bearish engulfing, and there are several confirmations also. You can see we had also a tap into this bearish order block, and it was just for continuations. And you can see we had all of this after using the rolling moving average to confirm that we are now bearish. Remember, the 50-day, the longer day moving average crossing above the shorter day rolling moving average signals that we are now bearish. And using support and resistance or key levels, in this case we are bearish, so we're looking at resistance levels. I'll be using it to enter trades. You could use your Fibonacci also. From this high to this low, we're looking to take trades from the 61.8 or the 78.6 zone, and you can see price reacting to that effectively. And if you take this to this level, from that swing high to this swing low, you have price reacting off of the 78.6%, which is a very deep pullback into the zone, into resistance, and the continuation to the downside. And we have several touches on the 20-day moving average, using it for resistance. You can see we had several, and the continuation. Have another one here. You can see this using the 20-day as resistance. So that is one effective way you can use the rolling moving average in your trades. Let me look for a bullish example. You can see we had this cross here, and after this cross we could start looking for buying opportunities. You can see prior to this cross we had this level, and price respected the 61.8% Fibonacci level, so we're looking to buy. And then we had the cross. As we had the cross, you can see this hammer. You can see series of hammer candlestick patterns here, and also this morning star candlestick pattern, also this hammer candlestick pattern there, and all this just points to buying opportunities. Also, you can use your Fibonacci from this low to the swing high, and you can see price reacting off the 61.8% level, which is also resistance turned support. So these are ways you can use the rolling moving average to trade. It's important you don't use it alone or in isolation. You use it with support and resistance levels so that you can get better trades. Use it with support, resistance levels, other technical indicators like your RSI to pinpoint overbought and oversold conditions in the market. You can use it with your Fibonacci also, like we use the Fibonacci. I like to use the Fibonacci, and you can use it with several support and resistance levels. Also, you can use it with trend lines. Let's see, we have this trend line here. So all of these are ways to combine price action with your rolling moving average indicator for better trade opportunities. So this strategy helps to filter out false signals. Let's look at the RMA and RSI strategy. Just gonna delete some of this. I'm gonna delete this Fibonacci, and let me just add the RSI. So looking at the RSI, we should be looking for overbought and oversold conditions in the market. And for this buy opportunity, you can see price, as we had this cross, you can see price giving us overbought conditions. So we'll be looking to wait for price to give us favorable conditions before we can enter the trade and to confirm this trade. So here we have price coming from below 50 and moving above 50 right here, and this corresponds with this zone, this area right here, and this shows that we should be looking for buying opportunities around this area, which is showing that it's a safe zone to enter. You can see after that we had the push to the upside, and let's look at this, our selling example, our bearish example. We didn't exactly have an overbought condition in the RSI, but we later had one here after the cross, which happened right here. Remember, this is where the cross happened, and this is where we are getting our confirmation for sales. And you can see this corresponds with price tapping into this resistance level, and that was how we would have been able to enter a short position from that zone with our confirmation, the RSI and the rolling moving average, to take profit around the swing low and stop loss above the high of our resistance zone. That's how I would have been able to catch this selling trade using the RSI confirmation. So this strategy helps filter out false signals and increases the probability of successful trades. But remember, why these strategies can be powerful, they should be used in conjunction with proper risk management and consideration of other market factors. Always test these strategies on demo accounts before applying them to live trading. So remember, why RMAs are powerful tools, they should be used in conjunction with other analysis methods and sound risk management practices. If you found this information valuable, please like the video and subscribe to the channel. Don't forget to turn on the notification bell to stay updated with our latest forex trading insights and strategies. Your continued support helps us deliver high quality content to assist you in your trading journey. Thank you for watching, and see you in the next one.